Today, we're doing a complete breakdown of Indian Accounting Standard 36. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before Indian Accounting Standard 36, companies often overstated asset values, leading to financial misstatements. Imagine reporting a building's value at 10 million rupees, while it's only worth 6 million rupees. Indian Accounting Standard 36 ensures assets are carried at recoverable amounts. By the end of this section, you'll grasp how this standard prevents financial illusion and promotes transparency. Indian Accounting Standard 36 exists to ensure assets on the balance sheet are not overstated. Imagine a company claiming equipment worth 15 million rupees that's actually worth 9 million rupees. This leads to inaccurate reporting. Indian Accounting Standard 36 mandates regular impairment testing, correcting such discrepancies. It enhances the credibility of financial statements by ensuring asset values reflect their true economic potential. Indian Accounting Standard 36 is mandatory for all entities under Indian Accounting Standard since April 1, 2016. The crucial requirement is annually testing for impairment, especially when indicators exist. Think of a tech firm with goodwill of 50 million rupees. Accurate testing ensures this isn't overstated. This standard's focus on recoverable amounts prevents assets from being falsely valued, safeguarding investor trust. The impairment testing model is about comparing an asset's carrying amount with its recoverable amount. If a machine is booked at 8 million rupees, but its recoverable amount is 5 million rupees, the company must write down the asset. This model ensures transparency, showing true asset values. Interviewers love this topic because it reveals how well you understand preserving financial statement integrity. Understanding the scope of Indian Accounting Standard 36 is crucial. Many candidates mistakenly assume inventories fall under this standard, which is a classic interview trap. Knowing what's included, like intangible assets and goodwill, versus what's excluded, such as financial assets, can make or break your interview performance. Indian Accounting Standard 36 applies to tangible and intangible assets, with goodwill being a significant focus. For example, a company with machinery that may be impaired needs to assess its recoverable value. This also covers patents, where valuation questions often arise. Goodwill, particularly from mergers, frequently requires impairment testing to ensure it reflects true value. Indian Accounting Standard 36 explicitly excludes inventories and financial assets, a point that can catch out candidates in interviews. Inventories are governed by another standard, while financial assets like bonds are managed to avoid valuation overlaps. Deferred tax assets are another exclusion, as they fall under tax-specific standards, leaving room for error if misunderstood. Impairment under Indian Accounting Standard 36 means a reduction in an asset's recoverable amount below its carrying value. Take a machine purchased for 100K, now with a recoverable value of 70K. This 30K impairment needs recognition in financial reports. Regular impairment testing, especially for goodwill, ensures assets are not overstated, preserving financial statement integrity. The recoverable amount in Indian Accounting Standard 36 is the higher of an asset's fair value less disposal costs, or its value in use. For instance, if fair value is $80,000 and costs are $10,000, but value in use is $75,000, then $75,000 is recoverable. This calculation is crucial for impairment testing, ensuring assets are not overstated on balance sheets. Navigating edge cases in Indian Accounting Standard 36 can be tricky. Land is included unless it's held for sale. Leased assets are covered unless another lease-specific standard applies. Assets under construction, often misunderstood, are excluded. Software licenses, however, are included, as they are considered intangible assets. Understanding these nuances helps you avoid common pitfalls in application and interviews. Imagine you're managing a firm with a diverse asset portfolio. Unexpected market shifts impact asset values, threatening financial accuracy. The impairment testing model under Indian Accounting Standard 36 is crucial here. It prevents overstatement of asset values, ensuring financial statements reflect true economic conditions and protect stakeholder trust. The impairment testing model is designed to prevent asset overvaluation. We'll follow Meridian Corporation's $10 million SaaS contract with an $8 million software license and $2 million in implementation services through these steps. Each stage checks whether asset values need adjusting, ensuring financial statements remain reliable under changing market conditions. Meridian Corporation's task is to pinpoint the smallest asset group generating largely independent cash inflows. For their $10 million SaaS contract, that means both software and implementation services form one CGU. Misidentifying CGUs leads to skewed impairment results. Indian accounting standard mandates CGUs be the smallest unit for accurate financial depiction, setting the stage for evaluating the recoverable amount. Meridian Corporation now calculates the recoverable amount for their CGU. This involves determining the higher of fair value less disposal costs, or value in use from forecasted cash flows. Errors here often stem from incorrect cash flow estimates. Indian accounting standard stresses using the higher value for precision, setting the foundation for comparing against carrying amounts. Meridian's calculated recoverable amount becomes the benchmark. Meridian Corporation compares the $10 million carrying amount of their SaaS contract to the recoverable amount calculated earlier. A common oversight is neglecting depreciated values, risking unreported impairments. Indian accounting standard dictates that if carrying amounts surpass recoverables, action is needed. Meridian finds their carrying value does exceed, indicating an impairment loss should be recognized next. Recognizing an impairment loss is crucial when carrying amounts outweigh recoverable values. Meridian Corporation must adjust their records as the SaaS contract's carrying value exceeds what was determined. It's vital to update financials promptly upon identifying impairments. Indian accounting standard insists on immediate recognition to maintain accuracy. Meridian's next step is allocation, ensuring the loss reflects across asset values. Allocation of impairment loss involves distributing it among CGU assets based on carrying amounts. Meridian Corporation ensures their loss is proportionately spread across software and services. Neglecting asset-specific contributions skews financial statements. Adhering to Indian accounting standard ensures losses reflect asset values accurately. Meridian's completed allocation finalizes the impairment testing, maintaining transparency in their financial reporting. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Indian Accounting Standard 36 mandates specific disclosures to ensure transparency and comparability. Recognizing impairment loss correctly can prevent misleading financial statements, affecting investor decisions and credit assessments. Learn how precise measurement and disclosure practices can safeguard financial integrity. Assets are initially recorded at cost when acquired, provided they meet criteria for future economic benefits and reliable cost measurement. The key date for recognition aligns with asset control transfer, typically the acquisition contract date. Indian Accounting Standard 36 requires impairment recognition if the carrying amount exceeds recoverable value, the threshold preventing inflated asset reporting. Regular impairment testing, especially at the reporting date, ensures immediate recognition of value reductions, maintaining accuracy in financial statements. Subsequent asset measurement under Indian Accounting Standard 36 involves regular reviews to ensure carrying value doesn't exceed recoverable amount. Annual tests or indicator-driven reviews prevent overvaluation. Impairment indicators like market declines or adverse changes trigger remeasurement, affecting income statements but not balance sheet historical costs. If conditions improve and recoverable amount increases, impairment reversals adjust future results, providing a realistic view of asset value over time. Financial statements clearly present impairment losses as a distinct income statement line item, emphasizing revaluation impacts. On balance sheets, impaired assets appear at net recoverable value, ensuring transparency. Disclosure notes detail impairment testing, methodologies, and assumptions, essential for stakeholder analysis. Adhering to classification rules distinguishes operational from non-operational assets, offering a precise view of asset roles and impacts on financial health. Indian Accounting Standard 36 requires detailed disclosures. Assumptions in impairment testing, such as discount rates, allow analysts to gauge sensitivity and risk. Identifying affected segments or assets aids transparency and precise evaluation. Disclosing recoverable amounts and determination bases highlights management's valuation judgments. Additionally, explaining changes in assumptions or recoverables provides insights into shifts in asset strategy or market conditions, enhancing analysis of financial stability and decision-making. Imagine a CFO faced with a $10 million asset whose market value drops to $7 million. Indian Accounting Standard 36 mandates an impairment test, leading to a $3 million loss recording, accurately reflecting current market conditions. Later, as value recovers to $9 million, a partial impairment reversal is recorded. Such actions improve financial transparency, ensuring stakeholders stay informed of evolving asset performance. This scenario underscores the critical role of timely impairment recognition and reversal in financial management. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. This comprehensive journey through Indian Accounting Standard 36 will illuminate the financial impacts from initial recognition through the life cycle of the lease. Indian Accounting Standard 36 mandates that leased assets like Meridian's warehouse be recognized as right-of-use assets with an equal lease liability. This entry reflects the initial obligation and asset acquisition, impacting the balance sheet by increasing both assets and liabilities by $1,200,000. This approach aligns with the framework's goal of transparency. As Meridian makes its monthly lease payment, the cash outflow reduces the lease liability. However, part of this payment is interest, not principal reduction. Under Indian Accounting Standard 36, interest on lease liability must be expensed, emphasizing the cost of using the asset and keeping financials aligned with actual cash flows. Amortization of the right-of-use asset reflects its consumption over the lease term. Indian Accounting Standard 36 requires systematic expense recognition, ensuring Meridian's financial statements show the asset's declining value. This entry affects the income statement by increasing expenses, thus reducing net income, and updates the balance sheet with accumulated amortization. An impairment review ensures assets are not overstated. Indian Accounting Standard 36 mandates recognizing impairment if the asset's recoverable amount falls below its carrying value. For Meridian, this $50,000 adjustment reflects decreased market value, directly impacting the income statement by reducing profits and updating asset valuation on the balance sheet. Lease modifications can alter financial obligations. Indian Accounting Standard 36 requires remeasuring the lease liability to reflect adjusted terms. Meridian's $30,000 reduction mirrors the updated lease terms, aligning assets and liabilities. Adjustments like these ensure the company's financial records accurately represent current obligations and asset values. Year-end closing ensures all income statement activities reflect within retained earnings. By transferring $160,000 in expenses from amortization and impairment, Meridian updates its equity section, completing the cycle. Indian Accounting Standard 36's structure ensures transparency, clearly delineating operational impacts on profits, thus providing stakeholders with a comprehensive financial overview. Derecognition marks the end of the lease's financial impact. Indian Accounting Standard 36 requires removing both the asset and liability from the balance sheet, reflecting the lease's fulfillment. For Meridian, this closure simplifies future reporting, ensuring the company's records no longer reflect this previously significant contractual obligation. Every Big Four and investment bank interview on Indian Accounting Standard 36 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. An impairment test determines if an asset's carrying amount exceeds its recoverable amount. It's conducted to prevent overstating asset values. Indian Accounting Standard 36 ensures accurate reflection of assets on financial statements. A common mistake is confusing impairment with depreciation. Remember, impairment is about valuation. Depreciation is about allocation over time. The recoverable amount is the higher of an asset's fair value less costs to sell and its value in use. It's critical because it determines if an asset is impaired. Confusing this with market value is a trap. Memorize. Recoverable amount safeguards against asset overvaluation. Once impairment is identified, reduce the asset's carrying amount to its recoverable amount, recording the loss in profit and loss. Indian Accounting Standard 36 requires disclosing the impairment's nature and amount. A common error is omitting disclosure details. Key takeaway: precision in recording and reporting is vital for compliance. Indian Accounting Standard 36 aligns closely with international financial reporting standards but differs in some guidance nuances. The cash-generating unit definition and specifics on value and use calculations vary slightly. Misunderstanding these can lead to non-compliance. Remember, ensure you're clear on guidance specifics to align with local regulations. Yes, Goodwill is included under Indian Accounting Standard 36 for impairment testing, unlike some other standards. The error arises when candidates assume it's excluded due to its intangible nature. Takeaway: always verify scope specifics to avoid costly misconceptions in financial reporting. The impairment loss is $30,000, which is the excess of the carrying amount, $150,000 over the recoverable amount, $120,000. This loss reduces the asset's value on the balance sheet and affects earnings. Avoid mixing up the carrying and recoverable amounts in calculations. Indian Accounting Standard 36 mandates disclosing the amount of impairment losses, reasons for impairment, and specifics of the impaired assets. Companies should also explain assumptions used in value and use calculations. Missteps in transparency can lead to regulatory issues. Always ensure comprehensive disclosure to maintain compliance and investor trust. Impairment involves a sudden reduction in an asset's recoverable value, while depreciation systematically allocates the asset's cost over its useful life. Misunderstanding this distinction leads to erroneous financial adjustments. Key point: impairment is unexpected, whereas depreciation is a planned, periodic allocation. Current assets like inventory and financial instruments are not tested under Indian Accounting Standard 36, as they fall under different standards. The confusion stems from assuming all assets are covered. Memorize this: always check asset classification against standard applicability to avoid errors. Understanding the basics of Indian Accounting Standard 36 is crucial. It ensures assets aren't overstated by comparing carrying amounts with recoverable amounts, calculated as the higher of fair value less cost to sell or value in use. This standard excludes inventories and financial assets from its scope. Knowing key terms like cash-generating units and impairment loss sharpens your grasp on asset evaluation. Indian Accounting Standard 36 requires annual testing for impairment, especially for assets with indefinite useful lives. Look for indicators like market declines or legal changes. Measure impairment using value in use, the present value of expected cash flows. Fair value reflects the market price of an asset in a transaction. Remember, impairment losses can be reversed, affecting future depreciation calculations. Preparing for interviews? Know how Indian Accounting Standard 36 aligns with international financial reporting standards, yet varies by region, especially in regulatory aspects. Disclosures need to be comprehensive, revealing key assumptions in impairment testing. Stay aware of common traps like overlooking market declines. Goodwill allocation to cash-generating units is crucial for testing. Understanding when and how impairment reversals affect financial statements will give you a competitive edge. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.